The market has been really volatile lately, down 2% one day, up 1.5% the next day. I know my account is up at least 20% right now for the year. And if you want to see all of my trades, they're linked down below. I am a professional investor competing in the 2026 US Investing Championship. But there's probably some things, maybe some mistakes that you're making that could be preventing you from consistent market gains. So let's watch this together and let's see just how much we can learn from it.
He is the MD of VectorVest UK. Very good morning to you, young David.
Morning.
Right, we've got a lot of slides to whiz through. Let's kick off. Headline, 4 mistakes preventing consistent market gains.
Well, yes, these are 4 mistakes that I've been involved with both retail and institutional portfolios. Well, since I suppose now about...
Oh, bro, Scottish too. I didn't expect that. Okay, here's what I want you to do. In the chat down below, before we get to these, I want to hear from you what you feel like are some mistakes. You could do 1, you could do 4, it doesn't matter to me. But I'm looking for audience engagement. What are some mistakes that you have seen preventing you from consistent market gains? Now, for me, the biggest mistake for me that was really, really, really hard to overcome was cutting my losers short, right? The old adage of cut your losers short, let your winners run out of control. That's what I like to say. I was the opposite. I was letting my losers run out of control and cutting my winners short. But that's what happens when you sell options, like literally. And I remember specifically working with Larry Hite, and he said, so Larry Hite was the very first $1 billion hedge fund manager. Larry Hite was one of my direct mentors and one of the original market wizards. What he said was, if you have a stop, you can never under any circumstance move it down. It only goes up. It never, ever, ever goes down. That was a big light bulb moment for me because I was like, regular traders before, I actually made money in the market. And it was like, if the market was going against me, I would just lower my stop. Oh, I'll give it 25 cents. And of course it blew through that. I'll give it 50 more cents. And of course it blew through that. You know what? I don't know what's going to happen today by the close. I see this a lot on Discord still. I don't know what's going to happen today. I'll just give until tomorrow. Right. And then it goes down even more tomorrow. Oh, it's okay. I'm going to give another $1.50. Boom, right? And what used to be a small loser has turned into an enormous loser. So the way to get around that is to honor your stops. I used to actually say unbreakable exit point or something like that. There was something, you can go back in my archive of videos. I've only made like 2,500 videos on YouTube. You can find somewhere, I think I said something like unbreakable exit plan or unbreakable exit point because I needed that. Because you know who was going to go break it? This guy. So let's see what you guys have put. Cutting losses, hoping it will improve. Yeah, I don't know where he's going to put that, but I would bet you that's a super, super common thing. Cutting losses short. Let's see. Dollar cost averaging on the way down. Yeah, exactly. Right. And now I've I don't know. There's some, I like to test things and this seems to be working well. Don't buy the dip. You want to buy the rip because you don't know how far down the rip or the dip is going to go. And you don't know how high up the rip is going to run. Right. So that is one of the things I'm really trying to push right now is don't buy the dip, buy the rip. Specifically because in the same logic, you don't know how far it's going to dip. You don't know how far it's going to rip. So why would you average on the way down? But that's super common. Don't feel like you've done anything wrong there, Jeff. It's super common. Holding trades for way too long, FOMO and holding losers too long, cutting your winners early instead of letting them run, hoping it'll come back. MJ Carney says, there are 2 things for me, cutting losers short and getting my position sizing correct with the capital available. That's really important too. Because position, like most people, maybe that's what happened with you, Jim. Most people are like, okay, I'm a trader. Traders only trade in 100 lots. I'm only going to trade 100 lots, right? And so you're buying 100 lots on everything. Well, the risk is vastly different on 100 lots of Coke and 100 lots of Tesla. They're as far apart as you could possibly get. But a lot of people don't understand. You can size your trades based on the volatility of that stock and the risk. So yeah, that's super important. MJ Carney, thank you much for that. Art, watching other YouTube channels. I agree with you. And you know what that really bothers me, Art, is like I've got right at 46,000 subscribers between our channels, the OVTLYR channel, my channel, and Joe's channel. We're pushing probably 60,000 subscribers, give or take. And I see other channels with hundreds of thousands, 400,000, 800,000 1 point whatever million. And I'm like, what are y'all doing? Apparently my content is so boring, right? Actually being a legitimate professional investor is so boring to most people. They want to go out and they want to hear from some jackass who has no idea what's going to happen in the future, but he's going to tell you, oh, I told you this stock's going to go up, buy more AMD because it's going to go up from here, right? As it continues to go down another 50%. Maybe I should just be one of those guys and just tell you what's going to happen in the future, right? But then the audience will probably hold me accountable, right? No, of course not. This is YouTube. Nobody remembers anything on YouTube. Position sizing, buying into a rally. Okay, actually, I would say that that's a good thing. I wouldn't call that a bad idea. Holding losers too long. Nate says ignoring exit signals is probably the worst problem I can think of. Listening to YouTube gurus, selling winners way too soon. FOMO. Let's keep going. Patience. Not cutting your losers short, FOMO, taking profits too soon, cutting losers. I mean, there's a theme here. There's a theme here for sure. Cam, who I still need to email. Cam, it's nothing personal. I'm the worst to email. I actually spent like 20 minutes on emails yesterday. It's yeah, I hate email so much, but I'm going to get back to you. I promise. Part of what we're doing is we're actually we are going to be interviewing a ton of people who have competed in the U.S. Investing Championship. I actually got the organizer, Dr. Norm Zada. I've booked him, so that's going to be coming soon. So I've got at least 6 people, including myself, who are going to be interviewed for it. Too emotional, panic selling, trading based on feelings, not having a plan, setting expectations. That's a really good one, right? When you buy a stock and it's SoFi, it has to go. Do you not understand? SoFi is the future of finance. And not only is it the future of finance, it's already had some huge runs. So of course I expect it to do it again, right? So if it's moved, and I can guarantee you, there are people who watched it go up 130%, who are now saying it's going to go up another 130%. Duh. I can't even do that. I have to like scroll off the page here. It's of course going to go up another 130%. Now I'm not selling until it does, right? I'm not selling until SoFi hits $57. There are people who legitimately think if a stock has done it before, it's going to do it again. And it may. It very well may. But if you hold and hope for that to happen, you could literally be holding and hoping for the entirety, the duration of the rest of your life, and it may never happen. It's true. It's very true. We don't know what's going to happen in the future unless you're one of those YouTube guys. And of course, they know better than me. They can see the future. And they are probably the ones telling you, look, it went up 130% already. It's going to go up another 130%. Duh, of course. But Art, he's got the biggest mistake that all of us have, which is not having the Nancy Pelosi right side of the chart. Exactly. The side of the chart that tells you the future. We don't have that Nancy Pelosi upgrade yet. So thank you guys so much for the participation. That was super fun. Let's learn from this incredibly handsome, I don't forget what they call them, young David or whatever. And listen, as a guy with 41% of my hair, I'm really grateful to have 41% because one day I might end up there. But I'm going to push that day off as long as I possibly can. Let's go.
1990. And I've noted these 4 mistakes coming up over and over again at both retail and institutional level. And hopefully, knowing about them, we can get our minds around them a little bit. So the 4 mistakes, the first one, which is in the next slide, I think encompasses many of them. And I've entitled it, Thinking of the Money First. Now, you may say to yourself, well,
that's a great one. I didn't expect that one. That's a great one. Now, tell me, when we talk about trading, what is the thing we think about most, right? What do we think about first? We're a what first type of trader, right? And I can tell you it's not money. We're not picking out the color of our Lambo on the trade. We're not thinking about where the mansion's going to be, the Lambo-shaped mansion. And we're not talking about how we're going to have our Lambo-shaped pool that's lined in gold leaf, right? We're looking at being a risk-first trader. Risk-first trader, right? That's super interesting because a lot of people have no idea what they're doing and they only focus on how much money am I going to make? Oh my God, I'm so excited about this trade. I wonder how much money I'm going to make. Professional traders think the opposite way. In fact, I think I have a slide for this. Let me see if I can find it real quick. I don't want to let this go by. Hold tight. I have lots of slides. Let me see if I can find the right slide real quick. Talking about being risk first. I think it's Minervini. No. Here we go. Pros focus on managing risk, implementing processes, and maintaining the discipline needed to consistently execute their plan, knowing that if they get that right, the money will take care of itself. When I worked with Minervini, two-time U.S. investing champion winner, he specifically had something like that we talked about. And he's like, listen, when you have a plan, the money just falls out. The money just automatically comes into your account. But you can't do it by panic selling or FOMO buying, right? When you have an edge and you work with that edge, the money takes care of itself. It is the truth. So super interesting to see this.
The only reason we're going anywhere near a market is to make money, and that's certainly true for every profession. But most of you think of the best dentist in your area.
Yeah.
With the biggest car and a practice full of, a waiting room full of customers. That gentleman has built his business up because he focuses on perfect execution of each procedure. And if he takes care...
This is actually really good. Forget the fact that they're inside of a spaceship with like the most camera cuts of all time. Forget the fact that they are literally docking somewhere in Sydney and about to like teleport everybody in Sydney off to their spaceship. But yeah, this is actually great content.
And focuses on perfect execution of each root canal. His waiting room will be full, and he can pretty much charge what he wants. And it's exactly the same in trading. Our objective as traders is to
bring me to your leader. Oh no, they're in London. Bring me to your queen. And of course, this was 7 years ago. Bring me to the queen. Now they'd be like, bring me to the king.
Focus on perfect execution of this one trade. Not worrying about the past, not thinking about the future, but following our simple set of rules on this one trade. And if we...
Dude, it's so right. Joking about the background, the content is gold AF right here. Focusing in on the execution of this one trade, right? Nothing matters except, am I going to follow the execution of this plan, right? There's 4 types of trades: good trades, bad trades, winning trades, and losing trades. A good trade is one where you follow your plan no matter what, like he's talking about right here. Just like a dentist going into a procedure, he's going to follow his plan from start to finish. Most people can't do that in trading. Most people suck so hard at trading because they have an idea, they have a plan, they get into it, they get emotional, they F up their account, and then they repeat the process over and over and over, and they wonder why they can't get ahead. It's because, number one, they don't have an edge. I had too much coffee. Number one, they don't have an edge. And number two, even if they have an edge, they can't consistently follow the plan that generated the edge, right? Larry Height, I believe. Yeah, Larry Height, one of my mentors, as I mentioned earlier, we talked about having an edge. And he said, listen, you can have an edge. You can have the plan. You can have everything perfect. But if you don't follow your plan, you never had a plan to begin with. If you want to be successful in the market and you have done the backtesting work to create an edge, and then you get into a trade and the trade doesn't work for you and you panic sell and you cry and you say, Chris, maybe sell my SoFi shares. You never had a plan, period, full stop. It never was there to begin with. You were not emotionally ready to take that trade. Let's keep going.
We focus on perfect execution, and if we focus on the process of trading, the cash will take care of itself.
I literally just showed that slide. The cash, the money automatically falls out. In fact, I have another slide from Larry Height. Where is he at? I'm talking a lot about Larry today.
And when you allow your mind the luxury to move to the past, in the next slide, you can become incredibly emotional. And our minds have been hardwired to relive the past. And we've also been hardwired to avoid pain. So your mind relives the past. It wants to avoid the pain, and you find up making a multitude of errors, mostly hesitating and not taking the trade that you should take. So,
and why do people hesitate? Why do people get emotional? It's because they feel like the trade that they're about to place right now has some sort of bearing from every previous trade, right? If you had a loser on the last one, oh no, I lost the last one. Maybe I'll lose this one too. Or if you had a winning trade on the last one, oh, of course I'm going to win this one, right? Both of those are emotional sides of it. But both of these trades are completely separate, unique. There are different buyers and different sellers. And because of that, you need to treat each trade as a unique circumstance. Most people can't do that either. right? Oh, I'm on a winning streak. Everything's coming up green. Here we go. Oh man, I went in with 8 times the size I normally do and I lost. That's super common.
As far as I'm concerned, the key to the exercise, in exactly the same way as the key to playing good golf, is to focus on perfect execution of this one stroke, not the last.
Actually, skinny buff guy, it's not our fault. We're wired to fail. This is the truth. This is why OVTLYR is called OVTLYR, because we don't act normal. The kinds of let me see if I can word this correctly. To be world class at anything, you cannot be normal. If you're a world class archery shooter, right? If you're a world class dentist, if you're a world class trader, you can't be normal. But to skinny buff guy's point, normal actually sets you up to fail in the market. And you can't be normal if you want to be successful in the market. You just can't.
One, not the next one. And the difference between a really good golfer and yours truly is that he can lose a few strokes on the 4th, and on the 5th he plays that as if that's never happened. Okay, he focuses on perfect execution of this one stroke.
Focuses in on perfect execution. That's it. Perfect execution.
And the rest of the errors are, in fact, are a part of this one. But on the next slide, I think the next biggest error is buying stocks.
I totally missed him talking about buy stocks as they're going down, right? This is a huge mistake. I didn't come up with this. In fact, all the way back in the 1950s. One of my top 5 favorite trading books is this one right here, How I Made $2 Million in the Stock Market. Nicholas Darvis was literally a dancer, not a rocket scientist. He literally went on the stage, shook his booty, and got paid to do so. He would travel the world trading through Telegram. I've never even seen a Telegram. And what he would do is he'd have his broker wire him the price of the stocks, and he made his own charts, and he would draw boxes, and he'd say, okay, if it goes outside of this box, meaning the price is going up, he would buy. If it came back down into the box, he would sell his loss, right, and just move on. Or if it continued to move up out of the box and into new boxes, that's what's called the Darvis boxes, then he would hold that for as long as it was. Now, one thing he would also do is he would buy all the stocks in a sector, right? So if the material sector was looking great, he'd just be like, he'd wire his broker, he'd say, okay, give me 5 of everything, right? And so all the stocks are moving up, and then one by one, once they stopped working, he would cut them out of his portfolio, and then he'd keep his winners and he'd let them run as long as they could, maybe months or years at a time. It was figured out a long time ago. You want to buy the rip because you don't know how high the rip is going to go. Do not buy the dip because you don't know how far the dip is going to go. Okay, I see that I missed the sound. It's okay. We'll make it work.
For example, there's a company, biggest mattress producer in the whole world, called Steinhoff. And
okay, just so you guys know, the professional YouTuber at work, if I click the OVTLYR University button and I keep the sound on, it'll echo. I did you a favor because I didn't want it to echo. Sorry.
But this time last year, it was trading in South Africa at 120 rands a share. It fell to 1 rand 50 a share during the course of the last year. So if you had bought that falling, I'm not saying for seconds you don't buy a pullback. A pullback in a strong trend, that can be a great entry point. And as I've told you, I think a couple of meetings ago, I like to look at 3 moving averages, 21, 55, and 89. And when
okay, 21, 55, and 89. I was curious if he was going to say 10, 20, 50. That's his short, intermediate, and longer term averages. When they all move together, they all move together. Pretty cool, right?
The 21's above the 55, which is above the 89. I've got a share in a strong trend. I'm buying a little bit of a...
That's really interesting. Different numbers, same outcome.
Pullback in that, but is great. But if it cracks the 89-day moving average, then I start to get worried. And buying stocks that are falling has bankrupted, the old 2 for the price of 1 has bankrupted more traders than anything else out there.
Yes. Okay, so let's move on to the next slide.
Well, the next one, of course, is a part of that as well, which is holding on to losers too long.
Yeah.
Where you get emotionally married to.
That's definitely something you guys were saying in the chat earlier. By the way, super funny. He's the loser. I thought about doing a little Chris Chains bit right there. No, I'm not going to do it. No, I don't want to overplay the Chris Chains bit, but of course, bro's not dressed like a millionaire, so you know he's not a millionaire.
So just holding on to losers too long. Yeah. Where you get emotionally married to a thing, and even worse, of course, is adding to those losers along the way. And in the UK, remember Marconi? Remember that icon of the FTSE?
Yeah.
Fell from £13 to a few pennies.
Yep.
So holding on to losers too long, and it took me a long time to find that fella in the T-shirt, but holding on to losers too long. And then the last big mistake, of course, in the next slide is, well, no exit plan. That's a part of that. But the last...
Yes, this is a great one because a lot of people get into a stock. Oh, my brother-in-law just bought this stock. Oh, this random guy on the internet said that SoFi is going to go to $84 a share because that way the CEO gets these huge bonuses. Maybe I should buy some. And they actually don't have an exit plan. Like legitimately, I'm just going to buy. Sell? Like that's probably going through a lot of people's mind. And that's exactly how they get caught in this. That is exactly how they get caught in the market cycle. The market cycle is real. People buy as the stock is going up. They found something that's actually working and they're so stoked about it. Everyone's a genius in a bull market. Then they don't realize that the moving averages, the 3 moving averages, mine or his, start to cross because they don't know what they're doing. And then they watch all of that go down and it's over. They've watched this entire move happen. Now, this is not just theory. Let's just go to Tesla for only a moment here. Only a moment here. Tesla had the market cycle happen just in 2024 to 2025. Tell me the market cycle is not real. The entire stage 1, stage 2, stage 3, stage 4, all 4 of those happened within the span of a few months. I can show you countless examples. It is a real phenomena because a lot of people have no exit plan whatsoever.
Big mistake in the next slide is, in fact, not focusing or not being aware of market direction.
Sorry, I had a big old mouthful of coffee. Not being aware of market direction. You got a big old watch right there, but you have no idea which direction the market's going. Now, it's easy for us outliers because we understand the 3 moving averages, the 10 EMA, the 20 EMA, and the 50 EMA. When the 10 is over the 20 and price is over the 50, that is mathematically, unequivocally, unapologetically, I don't have to put any sort of disclaimerly, moving up. And the same is true on the way down. Now, it doesn't tell you the magnitude nor duration, but it does tell you it is moving in a bullish trend. And you know how to do that.
Whether the market is rising or falling, everything follows from that. And it's like a roller coaster that I've put in the next slide. I think it takes one heck of a long time to get up there, but falls very fast indeed. Yeah. We've been coached again that buy and hold is the only way to go. I remember when I started in markets, it was my mentor at the time told me that when markets made a peak in 1970, it took them 21 years to actually get back up to that level again in real money. So buy and hold is just great.
Let's look at Cisco. Because Cisco Systems, I think I have to go to a weekly chart for this example here. Cisco Systems did exactly this, right? It ran the market cycle. Another example of the market cycle happening. It went up, or I'm sorry, from the top to the bottom, it fell 90%. You would need a 900% gain to get back to break even. And you can't tell me, oh, I don't know if it's trending up or down. You have no excuse anymore. If you have watched the video to this point, you have no excuse. In fact, type no excuses in the chat below. No excuses. You have no excuse. Because you understand which way the market is going. There's no possible way that you can look at this situation and say, oh, you know what? It's going up. Got to buy that dip. All right. Let's say you bought it here in February of 2000, right near the top. You don't know. Remember, you cannot see the future. Start a new thing. Until we get the Nancy Pelosi plan, all you see is it going up. And it looks incredible, right? It looks incredible. Oh, man. And here, I just bought some. Man, this Cisco stock is brilliant. I'm going to let it run as far as it can. Oh, yeah. I'm such a genius. Here it goes, baby. To the moon. Oh, man. I'm making so much money here. Oh, I am such a genius. Oh, wait a minute. Oh. Okay, this is looking kind of rough, but it's okay. It should go up, right? The most dangerous word in finance, should. It should totally go from, listen, it's okay. I'll buy some more down here because it's going to go up, right? I'll just average into my position. This is the logic of people in the moment. Because remember, We cannot see. It's one thing to like talk about the future that you can see, but in the moment you can't see it. Oh, this is going great. Okay, I'm back even. I've doubled my position. To the moon. Okay, it's fine. It's really fine. I'm really not stressing on it. See, I'm up. I'm sleeping great. We're in July now. Cool. I'm making so much money. All is good. And I'm just going to continue every single day checking my brokerage account. All is great. And then wait a minute. Things are just getting really choppy here. It's fine. I'll just double it again. It's fine. The 10's gone under the 20, price has gone under the 50, but that's okay. Random guys on the internet back in 2000, they don't know what they're talking about anyway. I need to buy more dip. I mean, it should go up from here, right? It got as high as $82 and now it's down into the 30s. So if I buy more, it'll go up, right? I'll be the guy who finds the bottom. I'll be that guy. I will find the very bottom candle and then, oh, frick, this hurts. Oh my gosh, this hurts so bad. This is the reality for most people. This right here is the reality of most people. In the moment when they feel that pressure, in the moment when they are nervous, anxious, upset, let's go through those emotions over here. When they're feeling anxious and denial and panic, in the moment, they can't pull the trigger to get out of the trade. In the moment, they cannot do this. And that is what happens to tons and tons of people because they're like, well, it's fine. I'll just invest for the long term. That's the real excuse that comes out. I will just invest in the long term. So it's cool, right? It'll be fine. I'm investing for the long term. I'm a long-term investor. So where I bought in February of 2000, I finally got to break even in February of 2022. 22 years later, it took to get back to break even. 22 years later. And we still have not recovered all-time highs on Cisco. There are people still ready and waiting to sell as soon as it gets up here because they've been holding on to it for 25 years. I'm not crazy. You're crazy. It really is happening.
If you've got many, many years to wait, nevertheless, at VectorVest, our motto is that we want to buy shares with great fundamentals that are rising, that are in the throes of a strong.
Right. Buy shares. If you could forget the fundamentals, you want to buy shares as it's rising. If you want to add fundamentals to it to help justify that position, by all means. But the fundamentals come out 4 times a year. So the other 99% of trading days are determined by price. That's it.
Strong trend, and we want to buy them when the general market is rising. So we're very, very aware of market timing, and we have market timing tools for traders who want to be swing traders, want to be spread bettors, and we've got market timing tools for long-term position traders. And that just shows the American market, the pullback to 2003, then what's now called the global financial crisis. And we've now got a market which is still rising, and it's still, in our view, a bull market fundamentally. Right. And although there was a furore in the paper last weekend that the Dow had pulled back, it only pulled back to the low of about 10 days ago. So it's hardly a bear market as yet. NASDAQ had a much more serious crack. But our fundamental model, based on the work of Dr. Bart DeLida, who's the founder of VectorVest, based on earnings, interest rates, and inflation, still tells us that we're in a U.S. bull market. Okay?
I think he's gone through all of his mistakes here. Yeah, so he's taking questions from the audience at that point. But listen, everything that he talked about 7 years ago, the same mistakes happened today. The same mistakes happened in 1950 when that book was written. The same mistakes happen over and over and over because that's what happens to normal people. I don't want you to be normal. I want you to be an outlier. Outlier is 82 cents a day, right? That's all you got to do is use outlier, and it will show you when stocks are getting more greedy, when the sectors are getting more greedy, and when the market's getting more greedy. And you can ride that wave up, right? You can ride that wave up as high as it goes. And then it will tell you as well, you know what? We've reached complacency. We have reached euphoria. When those areas of irrational exuberance come to town, one way or the other, it's time to get out of the way. So if you're ready to save time, make money, and start winning with less risk, click one of these 2 videos. Have a fantastic day. We'll talk soon.